Welcome. Accounting and Management Made Simple is your channel of choice where we break down complex and difficult accounting and management principles into simple, understandable concepts. Whether you are a student preparing yourself for exams or a professional looking to apply knowledge practically, this channel helps you to grasp and understand complex key topics with ease. Please subscribe, share, like, and comment. Thank you. Hello students. This is your tutor, Samuel Muchai, Accounting Made Simple. Today, I still want to help you solve a question on incomplete records accounting. This is an area that many students keep complaining about, and therefore I like helping you to understand every trap that the examiner can solve. And today, we want to solve a question that is May 2015 question 4B. May 2015 question 4B. Although we are showing this question within our video, these questions are online. If you just go to online and you say CASNEB past papers, financial accounting, you will always get them from 2015 all the way to the current day. And if you have not subscribed yet, please, I want to ask you, subscribe, like, share, hit the notification bell so that every time we load this kind of videos, we are able to be of help to you. Also join our online classes. They are going on for the last 16 years. Those who have been doing, and therefore we are very, very good in this particular area. So I want us to look at that question, May 2015 question 4B. And the question reads, Patrick Joe retired from employment on 31st of December 2013 and decided to venture into business. He bought an existing business on the 1st of April 2014, acquiring the inventory at a valuation of 1.142 thousands, furniture and fitting as 1.5 million, and goodwill for the remaining balance. He uses his existing bank account. Mark that. He uses his existing bank account and did not maintain a full set of accounting records. The only record available being a till book recording cash payments from the till. Surplus cash was banked periodically during the year. A summary of Patrick Joe's bank account. Please mark that. We are being given the bank account. For Patrick Joe. So even when we are reconstructing our accounts, we don't need to reconstruct bank because they have already been given. For the year ended at 1st of March 2015 was as follows. You are given the balance brought forward. The biggest temptation is to say the balance brought forward by Patrick Joe because it is his existing bank account. That is money that belonged to him. But that is money that belonged to him. But if you look at the credit side, which shows how the money was spent, the money was not spent on his own other than the personal checks, but the money was used on business. Meaning, the money which he had in the bank, his own money, he used it in business, and therefore that is part of capital injection. Then you are given pension, you are given banking from shop. So pension, again, it is money he received because of his retirement, but when you look at how he used it on the payment, he never used it on his own activities. He used it on business, and therefore it is still part of capital injection. Then we have banking from the shop. That's part of our sales. We are banking our collections. We are buying or we are selling in cash, but then we are banking whatever we sell. Then we have purchases of the business to help you purchase of the business. So you are being told we spent at 192, but you can see what we bought when we are buying the existing business. And therefore that way, we are able to help to arrive at our goodwill. Rent, 15 months to 30th of June 2015, rates 9 months to December 2014, electricity, hire of equipment, purchases, personal checks, and balance carried down. So the balance carried down gives you the closing balance for cash, which is a current asset. Then you are given what was a summary of the till book for the year ended at 1st March 2015 shows the following. You are being shown what he paid in cash. You are being shown what he paid in cash from his sales collections. From his sales collections. Number 2, other balances at that part of March 2015 were as given as follows. We are given as follows. You are given the closing balances. Furniture and fixtures are to be depreciated at 10% per annum on cost. Then you are required to prepare the income statement for the year ended at 1st of March 2015, and the statement of financial position is at 31st March 2015. Like I've said over and over again, incomplete records is about reconstruction of accounts. It's your ability to know and follow double entry rules to be able to know the missing item. If you look at that question, we have not been given sales anywhere, we've not been given purchases anywhere. And those are things that you're supposed to capture as you read your question. What have I not been given? And what do I need to do when I am, based on the information given? So if you look at that question, we are told that the purchase of business, if you look at the bank account, we are told that the person spent that 192 to purchase the business. Cost of business purchase. Cost of business purchase was that 192. Was that 192 shillings in thousands. Shillings in thousands. And we are told, what did he purchase? He bought inventory valued at 1142 less assets acquired. Less assets acquired. We want to net the goodwill. We are computing goodwill. We are looking for goodwill computation. Goodwill computation. Less assets acquired. So we have inventory. We acquired inventory amounting 1142, and we also acquired furniture and fixtures. Furniture and fixtures amounting to 1,500. Amounting to 1,500. If you add the two, 1142 plus 1,500, we get a figure of 2642. 2642. Now, if we subtract the money we paid that 192 to acquire assets worth 2642, and the question there tells us, and for goodwill for the remaining balance. If you look at the question, they told the remaining balance, because we paid that 192 to acquire assets worth 2642, the remaining difference is goodwill. The remaining difference is goodwill. So if we subtract that 192, you realize that we are getting 550 as our goodwill. So our goodwill is 550. Is a non-current asset. Is a non-current asset. Goodwill is 550, which is a non-current asset. Now we are told that if you look at now the capital, if we talk about the capital account, his injection is the balance brought down, which we are essentially we are doing double entry. We'll be debiting bank and we are crediting capital. That is 642. That is 642. The bank is already created, so we are not debiting bank because the bank has already been created. We don't repeat. So we have pension, which you are debiting bank and you are crediting capital, amount to 975, and then we have banking from shops. Now this is from collections. This is from collections. This is from collections. So cash, we are selling. If you look at the question clearly, we are being told that we are selling in cash. Some of the money we are spending before banking, and some of it we are banking. So we are getting money from cash amounting to 16,427, and we are taking it to bank. We are taking it to bank, amount 16,427. We are taking it to bank, and so we are getting money from cash, and we are taking it to the bank, and therefore our capital injection remains that amount. Our capital injection remains those two amounts. Our capital injection remains those two amounts. So if we add the two of them, we get that is 642. That is 642 plus 975. 975. We get the capital amount to 4617. Total capital amounting to 4617 before you can go to cash. But now we are told we took money from cash and we debited back. So we created money which we had collected here from sales. We have collected money from sales. Now we have taken the money to, we don't know how much we collected from sales. But one thing we know is that we took money from cash to bank. From the question, our question has bank account. Our question has given us the bank account details. And one of them is banking from the shop. Banking from the shop. Banking from the shop. Banking from where? From the shop. That is already given 16,427. So we don't need to do this. Because you have been given the debit of banking from the shop, you must know it is coming because we credited cash. We spent money, we got money from cash account and we took it to the bank. So banking piece we debited bank, and bank is already given, and then we credit cash. Cash is not given. Cash is not given. Remember, we need to reconstruct cash to know the amount of cash sales. We need to construct cash to know the amount of cash sales. I'm just dealing with the bank account alone, just slowly, without being in a big hurry. And then we go, the debit side, I'm through with accounting for the debit side of the cash, the bank account. I'm through with the debit side of the bank account. And then we upload purchase of business. Now the payment from the credit side of the bank account. Purchase of business, that 192, we have dealt with it here. Then rent, 15 months, rent account. So we are then again, once again, the bank account is given. The bank account is given, and we are told that we paid rent for 15 months. 15 months amounting to 500. And we are told it is for 15 months up to 30th of June 2015. We are told it's for 15 months up to 30th of June 2015. Now, our year, if you look at the question, the requirements, it is 31st of March. Income statement as a 31st of March 2015. So we are saying our year is 31st of March 2015. Meaning it starts on 1st of April 2014. Our year starts from 1st of April 2014. And we are told clearly he bought an existing business on 1st of April 2014. So now we paid rates not for 12 months but for 15 months. We paid rates for 15 months. But the one which we have incurred is only for 12 months. The one which have been incurred is only for 12 what? 12 months. And therefore, we say the one which you have not incurred is for end of March, April, May, June. 3 months. 3 months we have not incurred. 3 months it is not spent. 3 months is not spent. And therefore, we get 3 out of 15. We get 3 out of 15 and we multiply with the rates that we paid. We paid rates amounting to 500. We paid rates amounting to 500. So 3 times 5, 3 divided by 15 of 500, we get a figure of 100. We get a figure of 100. So we are saying 100 has not been spent. Although we paid rates for 15 months amounting to 500. If you go to the bank, we are told we are crediting bank and we are debiting rates with 500. We are crediting bank and we are saying we are crediting bank. Our bank account has been credited with 500, and therefore we now, because this is given, we record what has not been given. What has not been given is the rent expenses account. So we debit rent expense account with 500. These are credited to the bank. Now the corresponding account is debit rent account. But we are told out of this rent, 100 has not been spent. So we say balance carried down. Balance carried down is 100. It's not an expense. So as we take the less to P&L as an expense, 400, 100 is a prepaid rent. Prepaid rent. 100 is prepaid rent. This is prepaid rent and it's a current asset. This is prepaid rent. This is prepaid rent. Prepaid rent. And we know it's a current asset. Prepaid rent is a current asset. Then we are told rates for 9 months to December 2014. So we are told this is December, 1st of April 2014. So up to around December, 31st of December, up to December 2014, that's the far we have paid our rates. We have paid our rates for only 9 months. We have paid our rates for only 9 months. So we record our rates account, we make our rates account, and once again, the credit is in the bank, so we debit rates. We debit rates with 84. We debit rates with 84, and we are saying it is coming from bank account. It's coming from bank account. We are doing reconstruction. We are doing what? We are doing reconstruction. 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 So each one of them you extend. Because you have been given the credit, then you must ask yourself, where is the debit? Where is the debit? You must ask yourself, where is the debit? Then you are told, electricity 92. We paid for electricity an amount of 92. So we know the bank has a credit of electricity to record payment, so we debit bank 92 and we say it's coming from, we debit electricity account with 92 and we say it is coming from bank. Then we have hire of equipment at 80, hire of equipment. We are hiring an equipment, it's a current expense. We are not buying the equipment, we are hiring. We are hiring the equipment at the rate of 80 and it is coming from bank. It's coming from bank. Please realize I'm not reconstructing the bank account because it's given in the question. I'm reconstructing what is not given. I'm reconstructing what is not given. Then we are told we purchased inventory worth 14,700. So we debit purchases account. We debit purchases account. Once again, we have credited bank, so we debit purchases with the 14,700. 14,700, and we are saying it is coming from bank. It is coming from bank. It's coming from bank. Then we are told personal checks. Personal checks talks about drawings. Personal checks talks about what? Drawings. And therefore we create an account called drawings. And we are saying the bank has been credited, but drawings has not been credited. So we debit drawings. Drawings have not been debited. Drawings have not been debited. So we debit drawings with 1122. We debit drawings with 1122. And then we have balance carried down. So one of our current assets is bank. One of our current assets will be bank, and therefore that will be our bank balance. Then we are told summary of the year. These are the payments which were made from cash. These were payments which were made from cash. We are made from cash. So it was not recorded in cash. So we did purchases. We did what? We did purchases amounting to 1606. And we know when we buy things in cash, we credit cash because deduction and asset, we credit the asset account, and then we debit purchases. We debit purchases. So purchases increased with 1606. Increases with 1606, and it comes from cash. This coming from where? It's coming from where?
Cash. From
cash. Then we are told staff wages 742. So we are paying wages. We are paying wages amounting to 742. So we create an account called wages. We create an account called wages, and we are saying it is 742. It is coming from cash. It's coming from cash. We are just reconstructing the accounts. We are doing nothing else but just reconstructing the accounts. Then we are told sundry expenses 156. So we say we are paying sundry expenses 156. So again we have an expense called sundry expenses amounting to 156. And we are saying this is coming from cash. It's coming from where? It's coming from cash. Then we are told drawings, the 520. We are paying drawings through cash. Our money is being reduced by creating cash 520. And as we credit cash, we debit drawings. And we had a drawings account, so we debit drawings. This was from bank. Now we are getting from cash an amount of 520. An amount of what? 520. We are just reconstructing the accounts. We are just reconstructing the what? The accounts. Nothing else. Just reconstructing the accounts, and you just need to remember your double entry rules. Number 2. Once more again, as we do this, If you have not subscribed, please subscribe. Please subscribe. Support us as we support you. Subscribe and hit the notification bell. Share, like. That is the only way you can support us, even as support you. Also join our online classes. We are the best in this. For 16 years, we have been doing this. So then we are told, we have been given the closing inventory is 1542. So we know our closing inventory is 1542. Receivables, we are told our accounts receivable. What are you being told here? We are told these are money sales which we had done on credit. So our receivables is 74. How do you create a receivable? You create a receivable by sale. You create a receivable by what? By sale. We create a receivable by sale. You create a receivable by sale. Now, if we make our sales account here, we will say that you debit receivable as you credit sales. You debit receivable as you credit sales. Receivable as you credit sale, 74. And then you are told cash in hand. Remember by the way, our bank had a sale. Well, what did you record it somewhere? Our bank had a sale. I don't know whether I don't see like we recorded it. Our bank had a sale, banking from on the debit side of the bank. We have a banking from the shop of 1642. So bank, we have a bank here of 427. We made cash sales. We made sales which we took directly to the bank. 16427. It was a sale of 16427, but it was cash. It was cash. Banking from the. So we actually one of the payment through cash was we took to bank. We took to bank an amount of 16427. Now, it is part of our sale. It is part of our what? Of our sale. It is part of our sale. It is part of our sale. So we move step by step. That's receivable. Cash in a hand. Our balance carried down of cash. We are told our cash in hand is 54. Our cash in hand is 54. We are told accounts payable has a balance of 470. How did we get our accounts payable? It is when we buy on credit. It is when we purchase on credit. Accounts payable is 70. So we say purchases. We say what? We purchased on credit an amount of 470. We purchased on credit an amount of 470. So purchases increase the 470, and you are saying it is increasing because of accounts what? Payable. Accounts payable. And then you are so late payable 110. Our rates. Where are our rates? Our rates. These ones we had said it's up to December. We are told we have a balance of 120. 120. So we have rates payable. Rates payable is a current liability. So we have a liability called rates what? Payable of 120. We have a current liability of rates payable of 120. So if we were to close our accounts, our rates here would be 84 plus 120. 84 plus 120. We get a figure of 204. These ones we don't need to do much. Our total purchases becomes 14,700 plus 1606 plus 470. We get a figure of 1670 16,776. We get our purchases of 16,776. We get a figure of 16,776. Our total drawings becomes 1122 plus 520. Get a figure of 1642. 1642. Our wages, our sundry, our sales. If we add up our sales, we get a figure of 164 to 164. Our sales, by the way, we need to be sensitive about this. This is not what we should have done here, because we need to, when we make a sale, we debit cash because we are increasing cash, and we credit sales account. We debit cash, and we credit sales account. We debit cash and we credit sales account. So if we were to get the total cash collections, because we made sales in cash, part of it we took to the bank, part of it, even before taking to the bank, we did purchases, we paid wages, we sundry expenses, drawings, bank, and we had a balance of this. So the total amount of money spent and what we banked is our total sale. The total amount of money that we banked and the total amount of money that we spent gives us the total sales. Gives us the total what? So 16,427 plus 1606 plus 742 plus 156 plus 520 plus 16,427. Sorry, this I have double recorded. It should not have been there. 16,427 should not have been there, because we have it here and we also have it here. Plus 54. We get a figure of 19,505. We get a figure of 19,505. So we are saying we made sales of 19,505. So because we are collecting money as we sold, our cash increased with 19,505, but it was coming from sales. It was coming from where? It was coming from sales. 19,505. And therefore, this is what we take to the sales account. We credit cash as we debit sales, and we say cash account 19,505. What are we saying here? We are saying we were selling in cash. And we sold an amount of 19,505, but out of this amount of money that we sold, part of it we took to the bank, part of it we did purchases, part of it we paid wages, part of it we paid sundry expenses, part of it was drawings, and part of it is our closing balance. So this is sale. You are spending money from sales. And how do you account for sale? You debit cash and you credit sales account. You debit cash and you credit sales what? Account. In other words, in this case, we sold in cash and we sold on credit. Where we sold on credit, our accounts receivable increased with 74. Where we sold in cash, we got 19,505. So you add the two to get total sales. Plus 74, you get a figure of 19,579. 19,579 to give you your sales. And therefore, from there now we can easily do our income statement. So we do our Patrick Joe income statement. We are required to prepare income statement. For the year ended January 1st, of March 2015. And we know our sales. We know our what? Our sales, you said it is 19,579. We have said that our sales is 19,579, 19,579 shillings in thousands. 19,579 shillings in thousands. We have now returned inwards less cost of goods sold. We don't have opening stock, we have our purchases. And we say our purchases is 16,776. 16,776 less closing stock. Less closing what?
Stock.
And we say that our closing stock here is 1542. We say that our closing stock is 15. By the way, we had opening stock because we are told on 1st of April 2014, acquiring the inventory at a valuation of 1142. So we say opening stock, 11 what? 1142. So if we add 1142 plus 16,776, we get a figure of 17,918. We get a figure of 17,918. Now we say less closing stock, and our closing stock is 1542. 1542. So we subtract 1542 minus 1542. We get a figure of 16,376. We get 16,376, and we say this is cost of goods sold. Cost of goods what? So we subtract it, we get minus 19,570 minus 19,579, we get a figure of 3203. We get a figure of 3203 as our gross profit. Or as our gross what?
Profit.
Gross profit as our gross profit. As our gross profit. We don't have any other incomes, so we say less what? Less expenses. But there is something, by the way, we have not done. Additional information number 3, we are told furniture and fittings are to be depreciated at 10% per annum. So if we were to say depreciation, furniture and fittings, we are told it is 10% per annum, and we know our furniture and fittings from the bank statement, where the information we received, we acquired furniture and fittings amounting to 1,500. 1,500. 1,500. So the 10% of 1,500 becomes 1,500 becomes 150. Becomes one what?
50.
Becomes 150. Depreciation becomes 150. Then we look at the information given. We look at the information given so that we can pick the expenses. We can quickly pick the expenses. None of this. We have rent. We have rent amounting to 400. We have rent amounting to 400. We have rent amounting to 400. We have rates. We have rates amounting to 204. We have rates amounting to 204. We have rates amounting to 204. We have electricity amounting to 90. Electricity amounting to 90. We have hire of equipment. Higher cost of equipment of 80. Hiring cost amounting to 80. Mark that statement. We are not buying equipment, we are hiring. So it's an expense. Drawings, wages 742. Wages 742. Sundry expenses 156. 156. Inventory sales. So I think those are the expenses that I can see there. Those are the expenses that I can see there. So we need to add them up. We need to add them up. 150 plus 400 plus 204 plus 90 plus 80 plus 742 plus 156. We get a figure of 1822. Let me repeat it again. 150 plus 400 plus 204 plus 90 plus 80 plus 742 plus 156. We get a figure of I'm missing something here. Electricity here. If you look at electricity here, electricity is 92. This is 92, and here we have captured 90. It should be 92. It should be 92, and we add them now. 150 plus 400 plus 204 plus 92 plus 80 plus 742 plus 156, we get a figure of 1824, which becomes as total expenses. You get the gross profit minus total expenses, you get profit for the year. You get profit for the year amounting to 1824 minus 3203, you get a figure of 1379. Get a figure of what? 1379 is our profit for the year. That is our profit for the year, and like we've always done, we will put it here. We'll put it here, and we carry it because we will need it when we are doing the balance sheet. We put it here, and we will carry it when we need the balance sheet. 1379. 1379. We will add it to capital to get the, and then we subtract drawings to get the closing capital. That's the way to prepare the income statement. Once more, I want to urge you, if you have not subscribed, please subscribe, share, like, and join our online classes. This is what we've been doing for the last 16 years. Let's go to the balance sheet. Let's go to the balance sheet, or the statement of financial position. Let's go to the statement of financial position. Let's go to the statement of what? Financial position. Always remember your format. Your format should always be in the head, so that you can find out whether every item in your format, each of them, do we have it in our workings? Do we have it in our workings? If you look at this question, we have two non-current assets. We have goodwill, and we have furniture, fixtures, and fittings. We have goodwill and furniture, fixtures, and fitting. Patrick Joe, statement of financial position as at 31st of March 2019? 2021, eh? Should have been 2015. So we say assets, we say non-current what? Non-current assets. Non-current assets, we say cost, we say depreciation, and then we say net book value. Net book value. So our non-current asset is furniture and fixtures 1500, and we are saying it is shillings in thousands, shillings in thousands, shillings in what? They are not cows, they are not goats, they are shillings in thousands. So we say furniture and fixtures, furniture and fixtures. We say it is 1,500 minus 150. We get 1,350. 1,350. I hope that's correct. 1,500 minus 150. Yeah, it's 1350. 1350. Then we have goodwill. We have goodwill, a non-current asset. We said our goodwill is 550. We computed our goodwill here, and we said it is 550. Our goodwill is 550. So we add 550. We add 550. We get 0, 10, 8, 9, 1900. Total non-current assets. Total non-current assets. Total non-current what? Asset. Then you say current what?
Asset.
Current assets. Current assets. And you know, the first current asset is always inventory. The first current asset is always inventory. And you say that we have closing inventory of 1542. Closing inventory of 1542. We have trade accounts payable. We have accounts receivable. We have accounts receivable. We have accounts receivable amounting to 74. We have accounts receivable amounting to 74. We have prepaid. We have prepaid what? We said we have prepaid rent of 100. Prepaid rent of 100. Prepaid rent of 100. Remember the format? Then we say we have bank, and then we have cash. Our cash balance, we said it is 54. Our cash balance is 54. And we said our bank from the bank account given is store of 78. It is store of what? It is store of what?
78.
78. It is store of 78. So if we were to add our total current assets, 1542 plus 74 plus 100 plus 1278 plus 54, we get a figure of 3040. Let me see. Inventory 1542, accounts receivable 74, prepaid rent 100, bank 12. Let me confirm everything. Our bank final cash balance is 54. Our final cash balance is 54. Let's add them up. 1542 plus 74 plus 100 plus 1278 plus 54. We get 3048. You get what?
3048.
3048. Total current assets. Total current assets. Total current what?
Assets.
We add with the non-current assets plus 1900. We get a figure of 4948. Get a figure of 4948. We are saying total assets. Total assets, both current and non-current. Then we say, where did we get the money from? We say financed by capital and what? Capital and what? Capital and liabilities. We say we get capital and liabilities, and we know that our capital is this one, 4617. We say that our opening capital is 4642 plus 975. That is 642 plus 975. That is 6. By the way, if you look at the question, the balance brought forward is that is 646. It's not 42. That is 646. From the question, the balance brought down is that is 646. So that is 646 plus 975. We get a figure of 4621. 4621. 46 what? 4621. That becomes our capital balance. That becomes our capital. 4621. We say add profit for the year. Add profit for the year. And our profit, we say it is 1372. We kept it here. 1372. 1372. We add it, 4621. Our profit for the year is 1379, 1379 plus 4621, we get 6,000. We get 6,000. So we say less drawings. Less what?
Drawings.
Less drawings, and our drawings is 1642. 1642 minus 1642, we get a figure of 4358. 4358 as closing capital. As closing what?
Capital.
Closing capital. Then we don't have non-current liabilities. We have current liabilities. We have current liabilities, and we know one of our current liabilities, always based on the format, we talk about the accounts payable. Never forget that the format is bank overdraft, accounts payable, and then we talk about other creditors. We talk about other creditors, and we say that our accounts payable, yeah, it is here, 470. Accounts payable is a balance of what? 470. So we come here and say accounts payable 470, and we had rates payable. We had rates payable amounting to 120. We had rates payable amounting to 120. Rates payable amounting to 120. If we add the two, we get 0.7895. 590 total current liabilities. If we add all the sources of funds plus 4358, we get 4358 plus 590, we get a figure of 4948. We get a figure of 4948. That is capital and liabilities. Capital and what? Capital and liabilities. And you can see our capital and liability of 4948 is equal to the assets of 4948, and therefore the question is balancing. Once again, this is the way to do it. I want to urge you to learn to subscribe, share, like, hit the notification bell, so that every time we are uploading this kind of videos, we are able to inform you. Join our online classes. We've done this for the last 16 years. I can assure you we remain the best in our field. So, yes, thank you very much.